Hey Bowtie Nation, Joseph Hogue here in a special update video for you, sharing not only the 7 stocks hit hardest in 2022, but 3 of which I'm taking advantage of the crash to buy in March. In this video, we'll look at the 7 worst performers in the S&P 500 index, 7 stocks down more than 45% in the last year. I'll show you why each is falling, valuation measures, and then reveal the 3 I'm adding to our 2022 Bowtie Nation portfolio. Now for this video, I am working only from the S&P 500 companies, those 500 largest companies based in the United States. We'll cover the NASDAQ next month, but here I wanted to just focus on those large cap stocks with the financial power to survive and thrive once the market comes back. I'll leave a link to Stock Card in the video description below. Click through and then go to Portfolios in the top menu. You'll find the Bowtie Nation portfolio in the stock picks section. It's free to follow and you'll get email notifications whenever I buy or sell from the list. Don't forget to use the promo code Bowtie Nation, that's all one word in lowercase, for an exclusive discount beyond that free trial. We're getting started, but before we do, I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. I want to get right into that list of stocks to watch, so I'll show you how I found these and why I'm positioning the portfolio for a March rebound in stocks later in the video. The 7th worst performing stock in the S&P 500, with shares lower by 45% over the last year, Etsy Inc., ticker ETSY, and the first one I'm actually adding to the Bowtie Nation portfolio. Etsy is the poster child for that sell-off in growth stocks that dominated the pandemic. The company booked 111% revenue growth in 2020, and investors decided they would pay any price for a company that could rival Amazon. Now, the frenzy took shares over $300 each before falling to less than half that right now, about where they were in July 2020, but still 121% above the pre-pandemic price. Post-pandemic growth has slowed a little, but still a respectable 17.9% annualized pace in the most recent quarter, and the site has carved out a real niche in that DIY and craft businesses part of e-commerce. It's a personalized community feel that you're just not going to get with Amazon, and that competitive advantage has helped it grow to over 98 million active buyers, growth of 38% over the last year. Valuation is now down to 7.6 times on a price to sales ratio, which, despite it showing red here, isn't too bad for a growth stock. I generally won't even consider a growth stock until it's down below that 10 times price to sales. Etsy topped out at a price of nearly 30 times sales last year, so this current price is a huge discount. I love that competitive advantage Etsy has built on its platform, and the best part here, this is a growth stock with positive earnings. Etsy reported earnings of $3.80 per share over the last 12 months and has gross profitability margin well above the benchmark. Now, that positive earnings is important because it's what distinguishes Etsy and those other quality growth stocks from those that are still just trading on hype and a hope of someday making positive earnings. Analysts have an average price target of $234 per share over the next year, more than 82% higher from the current price. Etsy actually popped higher after earnings recently, but I still like it here up to at least that target price. Next, with a price loss of 45% in the last year, I'm also adding shares of the Gap, ticker GPS, to our 2022 portfolio. Now, shares of the Gap have always been a roller coaster, with management missing earnings expectations just as much as beating them. The stock price regularly crashes, only to jump back again on some really strong brands and apparel, so it's always been that if you can get in on one of these troughs, you can usually get a good 20 or 30% as it heads back up to that next peak. Now, this most recent sell-off has really been on a sluggish return to sales growth, with revenue down 1.3% on a year-over-year basis to the last quarter and down 15% for the entire year. Top this off with runaway expenses and an operating profitability that has fallen to 5.6% from a pre-pandemic of 8.2%, and earnings have suffered. Still though, the company owns some of the best brands in clothing. Old Navy is the largest individual apparel brand in the US, and while Gap and Banana Republic aren't what they used to be, they still get some solid sales. Athleta is still just a small 8% of the company's total sales, but it is growing and able to compete against rivals like Lululemon. Now, the company is in the middle of closing some of its underperforming stores, which should help improve profitability in the near term. I'm adding this one to the portfolio not just for that rebound potential, but because a lot of the recent additions are in that growth stock theme. So here I'm diversifying the portfolio a little with a stock that's going to respond to some of those other factors like lifting the supply chain issues and consumer spending. Analysts have an average target of $20.67 each for shares of Gap, about 44% from the current price, but still well below last year's peak of $33 each. To find our list of stocks, I used the sector tracker on sectorspider.com, and all you out there in the nation know this is probably one of my favorite free research tools. You can go to the tools here in the menu and look for the sector tracker, which shows you the performance of stocks in the S&P 500 by each sector of the economy. I love starting with this big picture idea of how each sector is performing. With that, I can drill down into the stocks in each sector, looking for the best of breed companies in each one. Looking at the year-to-date performance, you see what an absolute bloodbath it has been, with just one sector in the green and 10 in negative territory. Of course, stocks in the energy sector have surged on those higher oil prices and the Ukraine conflict, but everything else is down from 2% to nearly 18% on the year. If you want to get an idea of which stocks are in each sector, just click on any of these sectors and the list on the right is going to populate with those companies, the stock price, and the percentage change over the period. For our target list of hardest hit stocks, we'll go back here to the full S&P 500 index and then change this percentage change column from highest first to lowest. And here, I want to look at the 1 year picture to see those that have sold off the most since last February's peak. The fifth worst performing stock in the S&P 500, with shares down 46.5% in the last 12 months, Discovery, ticker DISCA. Discovery owns some strong TV channels here, including Discovery, TLC, HGTV, and the Food Network that reach 85 million US cable households and 200 million worldwide. But as with all the traditional media companies lately, here it's been all about the streaming. The company was only able to add 2 million streaming subscribers in the fourth quarter, ending last year with 22 million total. Now that's not even a bronze medal in the streaming wars, especially against the big dogs like Netflix and Disney. It's hoped that merger with Warner Media is going to help boost the content and reach beyond the DIY and reality programs it owns now. But I don't know, I gotta tell you, I'm hesitant to jump into any of these streaming stocks right now because we're seeing that content cost just balloon and eat away at profitability. And subscriber growth is also slowing as people pick one or maybe two services max. Now, Discovery does have the advantage in that most of its content is very cheap to produce. I mean, cooking shows and DIY home repair aren't going to cost you the $465 million Amazon is paying for its Lord of the Rings series. And valuation for Discovery isn't too bad here, with the shares trading for about 1.6 times on a price-to-sales basis, quite a bit less than the sector average, and even lower than some of the other media companies like Fox with its 1.8 times sales valuation. Analysts have a price target of $38.76 a share, almost 40% above the current price, and it's going to be interesting seeing this new company develop. Social media sites have been hit hard this year, and that's left Twitter, ticker TWTR, the fourth worst performing stock in the S&P 500, with a loss of 55.2% in the last year. Now, Twitter actually didn't have too bad of fourth quarter earnings and didn't sell off like a lot of the stocks we've seen, but probably only because the market has been expecting this pain for the last year and it's just sold off the shares. The company reported revenue up 22% on a year-over-year basis, which is solid but still under expectations. User growth was also strong at 13% to 320 million monthly users, though the US growth only came in at a 3% pace. Now, it was the costs that were the big downside surprise, though, with expenses up 35%, causing that operating profitability to almost halve to 11% in the quarter. And of course, the privacy changes in the iOS app have been the big issue with social media, limiting that tracking and ad revenue for a lot of these social media companies. Now, I expect Twitter and the others like Facebook to eventually find some kind of a workaround around this, but revenue growth is going to be uncertain until then, and certainly for the rest of the year. The fact that Twitter has never really been able to monetize its users to the extent that Facebook or even Snap has doesn't help either. Shares of Twitter now trade for a price of 5.2 times sales, which is a discount of 40% from the 5-year average of 8.6 times, and pretty much the same valuation on Facebook, though. Now, I might take another look if Twitter had a cheaper valuation here, but on that straight comparison back and forth, I like Facebook for its stronger monetization and other assets like WhatsApp and Instagram. Analysts do have an average target price, though, of $45.16 a share, which would still be 42% below the peak of $79 a share, but a return of 29% from the current price. We'll get back to that list of underperforming stocks, but why am I even looking at the losers? Why not just keep riding those energy stocks and the bank stocks that have boosted the portfolio to outperform the index? And this is something I've actually been talking about over the last couple of months, really since stocks started selling off on fears of those higher interest rates in late December, early January, but there is a very good possibility we get some kind of a relief rally here in March or shortly after. You see, before the Ukraine conflict, the market was singularly focused on that prospect for the Fed raising rates starting in March. Everything else, from inflation to economic data, it was all in relation to those fears. In late November, we started to see the market pricing in higher odds of a rate hike as early as March, and those odds kept growing until the Fed Watch tool on the CME website is at 100% probability of a rate hike this month. Now, this tool measures the probability of the Fed increasing rates at each of its meetings based on how interest rate futures are trading. You can select the month above to see market consensus for each Fed meeting. And here, if you look at the table at the bottom, the odds of a quarter point increase in this month's meeting is now at 83%, with a 17% chance we see a half point increase. And you can also see how that's changed just over the last month. A month ago, there was still a 15% chance that the Fed wouldn't start raising rates in March, and almost no chance of a half point increase. So as the probability for those higher interest rates rose, investors got progressively more worried that the party was going to be over for growth stocks and even the larger economy, and started selling off stocks. It was that classic sell the rumor scenario. But now in March, we're getting into the actual start of the rate hikes. And once that happens, I think investors start to see that higher interest rates aren't going to crash the economy. We'll get that collective sigh of relief from the market that even against higher rates, consumer spending is still strong and corporate earnings are still growing. After that sell the rumor, we get the classic buy the news rebound, and you're going to see the biggest gains here in these hardest hit stocks. Next on our list of stocks to watch in March, with shares down 55.9% over the last year, Paramount Global, ticker PARA. So the old Viacom CBS rebranded the company and is now Paramount Global, with that streaming service through Paramount Plus and Pluto TV, along with its library of network and cable channels. And with CBS and its other channels, it's got a broader reach with over 600 million households compared to Discovery's cable channels, but the content is also a lot more expensive to produce. But as mentioned, I'm already a little hesitant to jump into any of these streaming stocks, especially the ones outside those top 2 or maybe even 3 providers. Competition is still heating up here, and the content is getting more expensive to make. That race for subscribers is going to mean lower near-term earnings, and for some, that promise of future earnings may just never materialize. Now here, just between the two, if I had to make a choice, I think with the Warner Media merger, Discovery has the stronger library of content that it can offer streaming subscribers, and Discovery has that more defensible niche in the DIY segment versus Paramount's relatively generic content. Sales growth is similar to Discovery, but Paramount's shares are quite a bit more expensive, trading at 1.55 times on that price to sales basis and almost 15 times earnings. The average analyst target of $41.28 a share is 42% above the current price, though, on top of that solid 3.4% dividend yield. So if the company can add streaming subscribers cheaply, it's going to be one to watch. The second worst performing stock in the S&P 500, down 60.4% over the last year, shares of Penn National Gaming, ticker PENN, another stock I'm buying in March for the coming rebound. Penn National has one of the largest and most diversified footprints in gaming, with 44 properties in 20 states, as well as a strong start in online gambling and sports betting. Management guided to sales as high as $6.39 billion for this year, which would be 18.5% growth. Now that's a slowdown from the 65% growth posted last year, but right around the 3-year annualized rate. Growth is still there though, especially in the mobile gaming segment, which saw revenue jump in the most recent quarter and is likely to post a strong first quarter on Super Bowl betting as well. Now on this strength, the company authorized a $750 million share repurchase program for over the next 3 years, which is always a great sign, but I'm a little worried about earnings over the next year. DraftKings and these other casino stocks have been reporting heavy spending in that race for online and sports betting users. So while revenue growth won't be a problem, bottom line earnings are probably going to be weak for the next year, and that's what a lot of this stock sell-off has been about. Valuation is very attractive here, and I was actually surprised to see how low. You don't expect a stock posting 18% annual sales growth to trade for just 1.5 times on a price to sales basis. Now that said, the profitability on sales is very low for casinos and other gambling stocks, so even the growth stocks tend to trade for that lower price multiple than maybe your tech growth stocks, but this is still a very attractive valuation. The average analyst target of almost $65 a share is only 30% higher, but still only half of the peak of $142 a share it reached last year. We're coming up on the worst performing stock in the S&P 500, and actually one I recently started adding to my portfolio. But first, I want to open this up to you in the community. What stocks do you think I should add to the portfolio next month, and why? Scroll down and let me know in the comments below which stocks or stock are you buying right now. The best analysis gets that stock added to our Bowtie Nation portfolio in April. And the worst performing stock in the S&P 500, down 60.5% in the last year, PayPal Holdings, ticker PYPL, is actually one I did a complete analysis on just last week. PayPal is quickly becoming everything you need in digital finance. It enables retailer payments through its Braintree acquisition, allows you to send money internationally with Zoom, helps people with savings and couponing with its Honey app, offers bill pay and direct deposit as well with its high-yield savings account through a partnership with Synchrony. Bring this all together then with that Venmo digital app and you could conceivably handle every financial transaction through the PayPal ecosystem. With management's target of 20% revenue growth over the next few years, the company gets to $43.9 billion in sales through 2024. Now, analysts actually expect a little less, about 18% annual growth to just $41.9 billion. So when I did my valuation, I used a range of estimates to value the stock. Now, over the last year, though, revenue growth was hit after eBay stopped allowing sellers to get paid through PayPal. It's meant billions of dollars in lost revenue and is expected to be another $600 million drag on this year's sales. Another hit to the shares, though, driving the stock down 25% on its Q4 earnings release, was that slowdown in new accounts, but a lot of that was on management's cleaning out of a lot of spam and fake accounts. PayPal is still expecting to add over 20 million new accounts this year, and customer engagement grew 11% last quarter to 45.4 average transactions per account. Now that's the chart on the right here, transactions per account, and you can see it just keeps growing consistently. So even if new account growth is slowing a little, PayPal is getting more out of its existing accounts. Now I don't want to rehash all of the analysis from the previous video, but I do expect the stock to return as much as 120% over the next few years, and even more on the push into digital wallets. Click through and check out that video because it's why PayPal is one of my own biggest positions and why it's already in the Bowtie Nation portfolio. Check out the 2022 portfolio on StockCard or click on the video to the right for that full analysis of PayPal, why I think the shares could double over the next few years, and why it's one of my biggest holdings in my portfolio. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.